Usually, when you walk into a traditional bank, right, and ask for a loan, there's this expectation of a very specific, like, rigid process.
Oh, absolutely. It feels almost, engineered.
Exactly. You show them your income, they pull your credit score, a mathematical formula is applied, and the loan officer just kind of points at a screen and says, well, there's your answer.
Yeah, it feels binary. I mean, highly transactional. We tend to like our major financial decisions to be visible and objective, neatly categorized.
Right. But then you step into the world of insurance, and specifically the machinery that makes insurance actually function. And suddenly, that clean, automated loan process just vanishes.
It really does. Because now we're looking at a landscape that assesses human behavior, predicts the future, and, well, deals with environmental chaos.
Which is wild.
Yeah, it's the absolute definition of analyzing the unknown. It's where mathematical probability meets the chaotic reality of everyday life.
So if you are out there studying to become a chartered property casualty underwriter, a CPCU, or, if you're an insurance professional looking to sharpen your foundation, or really just someone curious about how the massive, invisible gears of this industry turn, you are in the right place.
Definitely.
Because today, we are diving deep into demystifying underwriting. It is the absolute core of the insurance business. And I've got this whole stack of study materials and notes in front of me to help us pull out the golden nuggets.
Which is great, because we really want to help you connect the dots so you aren't just, memorizing facts, but actually understanding the concepts.
Right. And to ground this, the sources offer a really helpful analogy. If an insurance company operates like a bank, underwriting is essentially the risk approval department.
That's a great way to put it.
Okay, let's unpack this.
Yeah.
Because insurance is notorious for taking simple concepts and burying them like layers of jargon.
Oh, completely. It's a bad habit of the industry.
Right. So if we strip away the industry speak, what are the fundamental actions this risk approval department is actually taking? Keep it to like 3 basic verbs for me.
Okay, 3 verbs. We can definitely do that. Underwriting is the process of evaluating, selecting, and pricing risks.
Evaluating, selecting, and pricing.
Exactly. You evaluate the risk, you select the risk, and you price the risk. I mean, if you're taking the CPCU exam or just trying to understand your own policy renewal, everything revolves around those 3 steps.
Evaluate, select, price. I want to push back a little, though, because it sounds incredibly straightforward when you say it like that, almost like a factory assembly line.
Sure, it sounds simple on paper.
Right, but evaluating a human life or a really complex business, it can't be that simple.
Well, no, you're right. The theory is straightforward, but the practice is incredibly nuanced. Like, think about the timeline of securing coverage.
Okay, walk me through it.
So a customer realizes they need protection. Maybe they're opening a commercial bakery. They submit an application.
Right.
Now, that application doesn't just automatically generate a policy. It goes to an underwriter whose first job is to evaluate. They're looking at this bakery and asking, what exactly are we dealing with here?
So they aren't just plugging in an address.
Not at all. They're looking at the type of commercial ovens, the fire suppression systems, even the training of the staff.
Oh, wow. So they're essentially acting as investigators, like gathering clues.
Exactly. And once they evaluate all that evidence, they move to the second verb, which is select.
Okay, so they have to make a choice.
Right. They have to make a hard decision about whether to accept this bakery's risk into their overall portfolio or decline it.
And if they do choose to accept it,
Then they move to the third verb, price. They determine exactly how much premium to charge for taking on the specific level of risk that, that particular bakery represents.
evaluate the evidence,
Yeah.
select the risk, price the policy.
Got it.
Yeah, that's the flow.
Which means underwriters aren't just like pushing paper around in a back office. They are actively shaping the company's future. 100%. They are the gatekeepers.
So if we connect this to the bigger picture, why does this specific mechanism matter so much? I mean, without a clear goal, evaluating and pricing is just sort of an academic exercise.
It is. If we connect this to the bigger picture, the ultimate purpose of all this evaluating, selecting, and pricing boils down to 4 distinct goals. And these goals keep the entire insurance ecosystem from collapsing.
4 goals. Okay, what's the first one?
The first goal is to accept the right risks. The industry calls these preferred risks.
Preferred risk. So in the real world, a preferred risk is exactly what you would hope to insure.
Exactly.
It's the 45-year-old driver with a flawless driving record who only commutes 5 miles a day, Or a homeowner who meticulously maintains their property, updates their plumbing, and puts on a new roof.
Yes, or commercial business with strict, well-documented safety management protocols. Those are the risks that stabilize a portfolio.
Okay, but to maintain that stability, underwriters also have to execute the second goal, right?
Yeah.
Which I assume is the opposite.
Word? You guessed it. Rejecting bad risks. Because, frankly, not everyone who applies for insurance gets it, nor should they.
Let's talk about that, because the sources are very clear on what constitutes a bad risk. But I really want to dive into the nuance here.
Okay, let's do it.
We all know a history of driving under the influence of DUI is a massive red flag.
Oh, yeah. Huge.
But let's say an underwriter is looking at a 45-year-old driver with a single DUI from, like, 10 years ago.
Yeah.
Versus a 25-year-old driver who has 0 DUIs, but they have 3 minor speeding tickets in the last 6 months. How does an underwriter view that?
Oh, that is a perfect example of evaluating frequency versus severity.
Frequency versus severity. Okay, break that down.
Well, a single DUI from a decade ago is a severe event, right? But the length of time without a repeat offense shows a change in behavior.
That makes sense. They learn their lesson.
Right. But the 25-year-old with 3 recent speeding tickets, that demonstrates a high frequency of reckless behavior right now.
Ah, I see.
And actuarial data shows that frequency almost always breeds severity. Someone who speeds constantly is statistically overdue for a major collision.
Wait, really? So the speeding tickets are actually worse in this scenario?
Often, yes. An underwriter might actually decline the 25-year-old or charge them an exorbitant premium while offering a standard rate to the 45-year-old.
Wow, that completely shatters a really common misconception, especially for beginners.
Oh, so?
Well, people sometimes view insurance as this giant, like, communal pool where everyone tosses in the exact same amount of money and just gets handed out to whoever has a bad day.
Oh, right. Yeah, no. The source text explicitly points out that insurance is not a charity. It is a business.
Not a charity. That's a good quote to remember.
And that reality drives the third goal, which is charging an adequate premium. This is the concept of risk-based pricing.
Risk-based pricing, meaning you pay for your own risk.
Exactly. The higher the risk you represent to the company, the higher your premium must be. Risk-based pricing ensures fairness within the system. You pay for the specific level of hazard you bring to the collective pool.
So if I bring a sports car and a lead foot to the pool, I pay way more than the person bringing a minivan and a defensive driving certificate.
Exactly that. And all 3 of these goals, accepting preferred risks, rejecting bad ones, and charging an adequate premium, they all funnel into the 4th and, honestly, most critical goal.
Which is?
Maintaining profitability.
Because if you fail at those first 3, there is a vicious domino effect.
A very fast, very destructive domino effect, yeah.
Yep.
If an underwriting department gets sloppy and accepts too many high-risk clients without charging enough premium to cover the inevitable accidents, claims just skyrocket.
And when claims go up, the loss ratio goes up.
Right.
Just to clarify for the listener, the loss ratio being the percentage of collected premiums that the company actually has to pay back out in claims.
Yes. And when that loss ratio exceeds expectations, profit just evaporates. The company could even face insolvency.
Wow.
So the overarching goal of underwriting is to build a profitable and balanced book of business. So the company actually has the funds to pay claims when real disasters happen.
Here's where it gets really interesting for me. Everything we just talked about makes logical sense. But how does an underwriter actually, accurately predict that risk?
That's the magic question.
Because I want to push back on the mechanics of this. How do they prevent this from just being an educated guessing game? Because staring at a paper application and trying to predict the future sounds like reading tea leaves.
It's a great question, and it's exactly why the CPCU exam focuses so heavily on this area. Underwriters do not guess.
They don't?
No. They rely on 4 highly specific criteria to strip all the emotion and guesswork out of the decision.
Okay, let's hear the 4 criteria.
The first one is loss exposure.
Loss exposure. Let's break that down. It sounds like we are evaluating the physical and environmental realities surrounding the applicant.
Yes, we're looking at the literal, tangible hazards. If it's a commercial factory, an underwriter assesses the manufacturing processes. Like, are they welding near combustible chemicals?
That would be bad.
Very bad. Or what is the building made of? Wood frame construction has a vastly different loss exposure to fire than, say, reinforced masonry.
Right. Or like for a home in Florida, Loss exposure involves topographical mapping to see if the foundation sits in a 100-year floodplain.
Exactly. They are evaluating the literal exposure to a potential disaster.
That makes total sense.
Yeah.
You're evaluating the environment. What's the next layer of criteria?
The next is loss history, and this operates on a very simple psychological and statistical premise. Past behavior is the single best predictor of future risk.
I mean, that's true in almost every part of life. So the more claims you've had in the past, the statistical probability of you filing another claim goes up exponentially.
Precisely. It's not just bad luck. It is a pattern of behavior or a pattern of vulnerability.
Okay, so that's 2. Exposure and history. What's the third criterion they examine?
The third is the characteristics of the applicant. And this changes dramatically based on the line of business.
How so?
Well, for auto insurance, they aren't just looking at the horsepower of the vehicle. They look at the driver's age, their years of driving experience, and their driving record.
Right. And the sources also mention that in many states, they look at a credit-based insurance score, which always feels a bit controversial to people outside the industry.
It does get a lot of pushback.
Yeah, I mean, why does a credit score matter if I'm a good driver?
It feels counterintuitive, I know.
Yeah.
But this is where actuarial science comes in. Actuaries, the statisticians who analyze all the data for the insurance company, they discovered a massive mathematical correlation.
Between what?
Between how people manage their finances and how they manage their physical risks. Statistically, individuals with lower credit-based insurance scores tend to file more frequent and more severe insurance claims.
Really? That's wild.
Yeah. The underwriter isn't judging your character, right? They are applying a statistical reality about risk probability.
Which brings us to the fourth, and maybe most important factor, in preventing underwriters from just guessing based on their gut feelings.
The fourth criterion, underwriting guidelines.
Underwriting guidelines. This is the rule book.
It is the absolute rule book.
But how do these guidelines actually get made?
This is a crucial collaboration. Actuaries crunch decades of historical data to find risk patterns. Then, they hand those patterns over to underwriting management.
Okay.
And management creates strict coded standards, the guidelines. It completely removes the subjectivity. The guideline tells the frontline underwriter exactly how to interpret the exposure, the history, and the characteristics they just gathered.
Okay, let's make this really concrete for anyone listening. An underwriting guideline might explicitly state something like, if a homeowner's roof is older than 25 years, the guideline mandates a physical inspection before a policy can even be quoted.
Yes, that's a very common one.
Or, if an applicant has a reckless driving conviction within the last 3 years, the guideline dictates an automatic decline. Like, there's no debate, no need for the underwriter to trust their gut. The rule book just says no.
Exactly. Those guidelines ensure consistency. Whether an underwriter in New York or an underwriter in California looks at the exact same application for a commercial fleet of trucks, the decisions should be identical.
Because they're operating from the same mathematical playbook.
Right.
So after gathering all this environmental data, pulling the claims history, checking the characteristics against the credit score, and consulting the actuarial guidelines, the underwriter has to actually, render a verdict.
The moment of truth.
Let's say I am an underwriter looking at a coastal property in a hurricane-prone area. The roof is relatively new, but the loss exposure to wind is undeniably high. What are my options?
Well, you have 4 possible decisions you can make, and you really have to master these for any industry exam.
Okay, what's decision number 1?
The first decision is straightforward. Accept.
Accept, meaning normal coverage.
Right. The risk is good, it meets the guidelines perfectly, and you offer normal coverage at a standard rate.
But in my coastal property scenario, standard coverage might be a little too risky for the company to absorb completely.
Which brings you to the second decision, except with conditions.
Except with conditions.
Yeah.
Okay, how does that work?
Well, the overall risk of a homeowner is acceptable. They pay their bills, they maintain the house, but the specific wind exposure is a concern. So the underwriter might add a limitation.
Like what kind of limitation?
They offer the policy, but they require a significantly higher windstorm deductible.
Oh, I see.
The homeowner assumes more of the upfront financial risk if a hurricane actually hits, which makes the math work for the insurance company.
So you are managing the risk by altering the terms of the contract.
Exactly.
Okay, let's say a different applicant comes along. They have a pristine home, but they had a kitchen fire claim 2 years ago. I don't want to decline them, but they aren't a preferred risk anymore.
In that case, you might choose the third option, rate up.
Rate up.
Yeah.
So just charging them more.
Basically, yes. The underwriter acknowledges that the risk is higher than normal, but the company is still willing to provide standard coverage, provided they can charge a significantly higher premium to offset that elevated risk.
It all circles back to charging an adequate premium for the hazard presented.
Yep. It always comes back to pricing the risk accurately.
And what's the fourth option? I assume it's just the end of the road.
Decline. The risk is simply too high. It falls completely outside the company's underwriting guidelines. Perhaps the home is, I don't know, literally on a crumbling cliffside and no coverage is offered.
So accept with conditions, rate up, or decline.
Those are your 4 verdicts.
Okay, so what does this all mean? Especially for you listening. If you are staring down a CPCU exam tomorrow morning, we need to distill this into the absolute essentials.
We definitely do.
Let's look at a major trap that students fall into. Confusing the NAIC with the underwriting department.
Oh, this happens all the time. You have to keep their roles entirely separate in your mind.
Okay, so define the NAIC for us.
The NAIC, the National Association of Insurance Commissioners, is the regulatory body. They create the frameworks, the model laws, and the consumer protection standards.
So they're the watchdogs.
Right. Their goal is to make sure insurance companies remain solvent and treat consumers fairly.
They are the government writing the traffic laws and making sure the roads are safe, whereas underwriting is the business side.
Exactly. Underwriting is the insurance company deciding who gets to drive the company car based on their own internal guidelines for profitability.
So NAIC equals rules. Underwriting equals business risk selection. Do not mix those up on a test.
No, definitely not. Regulatory rules versus business risk selection. Keep them separate.
Let's tackle some of the advanced vocabulary from the sources, too. The words that immediately signal an underwriting concept. We see terms like risk selection, predictive analytics, and inspections.
Good buzzwords to know.
But 2 terms that always seem to trip people up are moral hazard and physical hazard. Let's paint a picture of how an underwriter evaluates these.
Okay, so both increase the likelihood of a loss, but they stem from very different places.
Start with physical hazard.
A physical hazard is a tangible condition. Imagine an underwriter is looking at a warehouse. If the inspector finds frayed electrical wiring right near a pile of cardboard boxes, that is a physical hazard.
So it's an environmental reality that increases the chance of a fire.
Exactly. It's physical. It's right there in front of you.
But a moral hazard is entirely behavioral.
Yes. Consider that same warehouse. Let's say the wiring is perfect, the building is pristine, but the underwriter discovers the warehouse owner is severely in debt, facing bankruptcy, and has a history of insurance fraud.
Oh, wow. Yeah, that's a problem.
That is a moral hazard. It's an internal characteristic or a circumstance of the applicant that increases the likelihood they might intentionally cause a loss.
Like arson, just to collect the insurance money.
Exactly. Underwriters have to evaluate both the physical environment and the behavioral history.
To tie a bow on all of this, the source material offers a really great framework for remembering the core function of everything we've discussed today.
The memory trick. I love this one.
Instead of memorizing a sterile textbook paragraph, we can look at the engine of underwriting as a simple formula. 3 actions plus 1 goal.
That really is the ultimate takeaway for this whole deep dive. The 3 actions are evaluate, select, price.
Right.
And the 1 goal is profit. Evaluate, select, price for profit.
That is the entire architecture of the industry right there.
It really is.
If you can remember that, you understand that underwriting isn't just, a mountain of arbitrary paperwork. It is the vital pulsing mechanism that keeps the entire insurance system afloat.
Absolutely. By evaluating accurately, selecting carefully, and pricing correctly, underwriters ensure that the company actually survives.
Right, survives to actually pay out the claims when families and businesses need it most.
It's what holds the whole promise together.
As we look to the future, I want to leave you with a thought based on some of those concepts we mentioned, like predictive analytics.
Oh, this is a big one.
Think about how rapidly data collection, satellite imagery, and artificial intelligence are advancing right now.
It's moving incredibly fast.
As algorithms get incredibly precise at predicting physical and even behavioral hazards, will the role of the human underwriter become completely automated?
That's the million-dollar question.
Or, because we are fundamentally dealing with complex human behavior in ever-changing real-world environments, will the human element of selecting risk always be necessary to truly build a balanced and fair book of business?
It's fascinating to think about. Does the risk approval department eventually just become a supercomputer?
Or is assessing human risk something only humans can ultimately understand? Think on that as you prep for your exams or head into your next meeting.
Good luck studying, everyone.
Thank you for joining us on this deep dive into the mechanics of underwriting. Keep asking questions, keep exploring, and we'll see you next time.